Hi guys, welcome to lesson 3 on technical analysis. In the previous lesson, you learned about the importance of having an edge in the markets. Just like the casinos have an edge over the players, and that's how their business model generates profits consistently. So in our trading business, how do we get this edge in the market? Well, we get it through technical analysis. And technical analysis helps us to anticipate the probability of a price movement. Now, every single day, the market price can either go up or go down. So if you were to toss a coin every day, and if you get a heads, you go long, and tails, you go short, in the long run, you're going to be right half the time, right? Because it's random. So we want to be right more than half the time. Just like the casino is right 52% more than the player, for example, 5% edge in the market. So we do that by studying technical analysis. And technical analysis is really about the study of collective emotional patterns that are captured on stock price charts. See, you got to understand that in the short term, and when I say short term in this context, I'm saying less than 3 years, right? In the short term, the stock market is not always rational. In fact, the stock market is irrational very often. In the short term, the stock market is emotional. Prices go up and down every single day, but it doesn't mean that the company has changed, right? The company is making the same profits, having the same directors, having the same service and product. So what makes the price go up and down every single day? 5% up, 5% down, so on and so forth. It is not logic, it is emotions. So in technical analysis, we are kind of like being a psychologist. As a psychologist, you're studying your patient, right? And how do you anticipate your patient's emotions and how they're likely to behave? Well, you look at their facial expression, you look at their body language, right? So when you look at a stock chart, it's kind of like looking at the body language, the facial expression of that stock, all right? So from there, we can tell what are the emotions driving this stock. Is the market more and more bullish on this stock, which means more optimistic, or is the market very pessimistic on this stock? Bearish. Okay? And again, if it's bullish, the probability is that the price will go up more likely than going down. And when the market is bearish, the price will go down more likely than going up. Again, it's not a guarantee. Just because I can study my client and say, oh, he looks angry, I think he's going to lash out. It doesn't mean he's going to lash out. It's just a probability. Now, all we need to do is to be right more than random chance. We don't have to be right all the time. In fact, it's impossible to predict with certainty. All we need is a statistical edge in the markets. So take a look at this example. This is Domino's Pizza, for example. And it was selling at $14. Right over here. Okay? And what happened? Within a span of 4 months or 3 months, it went from $14 to $7. Right? How did it happen, right? Now, in 3 months, did the company change? No, it sold the same number of pizzas. It made the same profits, right? Same customers. But how did the value of the company drop by 50%? Now, let me tell you something crazy, right? It has got nothing to do with the company. If you remember this date, 2008, September, October, November, that was the great financial crisis, right? When Lehman Brothers collapsed, AIG almost went bankrupt. And people panic. They say, oh my God, it's the end of the stock market, you'll never recover. And because of the panic and the fear, people sold. So when you got more sellers and no one dares to buy, what happens? The price collapses from $14 to $7. Now you may say, hey, that's a great opportunity, right? That's cheap because the company is selling at half price. But what would have happened if you bought at $7? 1 month later, you went to $2.80, right? So you can see that again in the short term, the stock market is irrational. It is illogical. It's purely emotional. And so many people, not knowing this, when they come into the stock market, they don't get it. They say, I don't understand. I bought this company. It's a good company. Why did the price go down by 50%? Or why is this a lousy company is losing money, the price went up by 80%? Because it's got nothing to do with logic. It's got to do with emotions. And once you understand that, you can begin to make money more consistently in the short term. And again, we study emotions by studying price patterns. collective psychology. So imagine, wouldn't it be great if you could kind of like read the emotions of the market and learned to be able to, for example, sell at $12 over here, right? And when it collapsed, bought it back at $3, you would have made a lot of money, right? Or you could have bought it back at $4 or $3 and held it to $14 and avoided this crash. Could we do that? Absolutely. And I'm going to teach you how to read price patterns on charts, how to read trends in order to time your entry with the greatest precision. So let's begin this lesson. Now, before we go into the specific strategies, let's understand the fundamental principles behind technical analysis. And the first principle, the most important principle to understand, is that market prices, stock prices, discount all known information. So the market discounts everything. All information, past, current, and even future information is reflected in current prices. That is why in the short term, as a short-term trader, reading economic news, fundamental news, like balance sheets, income statements, GDP, unemployment is a complete waste of time. Why? Because market price is the leading indicator to all this fundamental data. And by the time you read this fundamental data, it's too late. The price has already moved in that intended direction, and you're always late to the party. Let me give you an example. Prior to the 2016 US election between Donald Trump and Hillary Clinton, Caterpillar's stock price was going down. As you know, Caterpillar is in construction, right? So the price was going down. Now, what happened was the moment Trump won the election, Donald Trump won the election, and the news was announced, within a split second, Caterpillar's share price jumped up by 10% immediately. Why? Because Donald Trump had promised that if he won the election, he's gonna, build a wall. He's gonna go into a lot of infrastructure spending. Government gonna spend on building bridges and infrastructure, right? So the moment Trump won, the market anticipated that Caterpillar, being a construction company, would get all these construction orders from the infrastructure building. And as a result, the share price went up 10% in anticipation that it will happen. So this information that is going to happen in the future has been priced into the stock immediately today. Now, I got a question for you. Has the government actually spent on infrastructure? No, not yet. Has Caterpillar actually gotten those orders? Not yet. But the share price already anticipates that it will get the orders. All right? Now, by the time the government really spends on infrastructure, by the time that Caterpillar really does the work and shows the profits increasing in its books, by that time the share price would have already risen. And if you were to buy the share price based on looking at this great fundamental data, you are always the last one to the party. And that's why most people who buy based on fundamental data, income statements, balance sheets, and all that, find that the moment they buy, the price drops. Okay? Because that good news, if you will, has been priced into the stock even before it happened. So relying on fundamental news always causes you to react too late. Let me give you another example from a macro perspective. Okay? This is how the stock market cycle, shown with the red line, corresponds to the economic cycle, shown by the green line. You can see the stock market cycle, which is determined by stock prices, does not move together with the economic cycle, which is measured using GDP. In fact, the stock market leads the economy by 6 to 9 months. So the stock market is a leading indicator of the economy. So here's an example. Back in October 2007, the stock market, which is again the red line, was at a high, was at an all-time high. The Dow Jones was at 14,000 points, all right, at this point of time. And so that was the, as you can see, market top. Okay. Now, the moment the financial crisis hit, what happened? The stock market reversed into a downtrend. So prices started coming down. So over here, you can see the stock price coming down, right? Now, here's the interesting thing. notice that as the stock price is coming down, the economic GDP cycle is still going up. Right? Why? Because the stock market anticipates that the economy will contract even before it happens. The stock market leads the economy by 6 to 9 months. So people who read the economic data, they say, hey, you know what, the economy is doing well, factory orders are rising, exports are growing, and they read this data that, hey, economy is growing, what do? They buy more stock. As they buy more stock, they find that by buying the stock, it's going down. Say, hey, how come I'm losing money when the economy is doing well? All right? Now, by the time the economy over here, by the time the economy starts to contract, GDP starts to fall, what happens? By that time, you can see that the stock price, the red line, has dropped by 70% to the bottom. So people who rely on reading the economic data and saying that, hey, the economy is doing badly, I better sell the stock. By the time they sell, what's happening? They're selling close to the bottom and they've lost 70% of their money most of the time. All right. Conversely, you can see over here, this was the market bottom. And this was February 2009. So the market bottomed here and it started reversing trend. It started going on an uptrend over here. Right? So notice as the stock market is going up, what's happening to the economy? That's right, the economy is still going down. The economy is in full recession. Right? So many people at that point of time, they will not dare to invest in the stock market because they say, hey, how can I invest when it's a recession? Times are bad, right? I better not buy. And they don't understand that the stock market is really moving up because the market, again, leads the economy by 6 to 9 months. The market anticipates that the economy will recover even before it recovers. Okay? So what do most people do? Most people, they will wait for the economy to recover. Can you see this early recovery, right? They will wait for it to recover. And the moment they see that, hey, the economy is recovering, and they say, I better invest in the stock market. Now, what happens by the time? By the time they invest, they will be buying near the top, right? So that is why in most people lose money in the stock market because they buy at the top over here and they sell at the bottom over here. Okay? Because they're looking at the wrong thing. They're looking at the economic data. They're looking at the fundamentals, which always cause them to act too late. So remember, your entry and exit decisions must always be based on the price action, where the price is moving. And we study that using technical analysis. The second principle of technical analysis is about probability and not prediction. Many people, when they learn technical analysis, they use it to attempt to predict the direction of the stock price. They say, okay, based on this indicator, based on this signal, the price is going to go up, the price is going to go down. And that's completely the wrong way to use this technique. Because remember that no one can predict the future. The future is random. Okay, the future price is driven by demand and supply, which is driven by emotions. Okay, now no one can predict people's emotions the next day. But what we can do is we can find not predicting with certainty, but it is used to anticipate the probability of future price movements. So there's a big difference between prediction and probability. Prediction means you're saying, hey, it is sure to go up. And if it doesn't go up, I'm wrong, right? And that's the wrong way of looking at it. Probability means it is more likely to go up than it is to come down. Now, it doesn't mean that it's going to go up now. It means that over a large number of trades, over time, you'll be right more often than you're wrong. But on this particular scenario, you may not be right. Just like the casino model, right? The casino knows that over many plays, they're going to make money from the player. But for any single bet, they do not know whether it's going to be a winning bet or losing bet. And when you have this philosophy behind the strategy, you will not be disappointed when you have a losing trade. Instead, you see it as part of a larger statistical process of having an edge and being right at the end of the day. Okay? Remember, having just a slight edge over the market will make you immensely profitable. So technical analysis, which is this entire lesson, lesson 3 and lesson 4, we're going to be learning the different parts of technical analysis. The first thing would be identifying trends, one of the most important things. We'll be learning about support and resistance levels, which are supply and demand zones that help us to anticipate where price is likely to reverse. Next, we'll be learning about moving averages, technical indicators, candlesticks, price action, and as well as other indicators to add on to the mix. So let's get started with identifying trends. One of the first things you have to do when you look at a stock chart is to determine the current price trend. So if you look at stock prices on a chart, notice they don't move completely randomly. They move in cycles or trends. For example, if you take a look at Apple over this period of time, this is kind of like 2, 4, 6, 8. It's about a year, right? And you notice that over this period of time, from November to somewhere in late January, it was on a downtrend, right? It was on a clear downtrend. Evidenced by the fact that you can see the price is making lower highs, right? Lower highs. And making lower lows. In fact, that's the definition of a downtrend: lower highs or lower peaks and lower lows. Now over here you can see that it attempted to make a higher high, right? So some people may have thought, hey, could that have been a change in trend? But although it made a higher high, it went back to make a lower low. So that was not a change in trend, all right? So this is a period of a downtrend. And in February, the price was pretty much going sideways. It was in what we call a consolidation pattern, where the price was kind of like making the same level of highs, same highs and same lows. It was moving sideways, directionless. And in March, you can see that it started a new uptrend. Again, how do you know? Evidenced by the fact that you see the price making higher highs or higher peaks, right? And higher lows. So it's really important to know right now what's the current trend. So for example, if we were right now in April, you would see that Apple is on a very clear uptrend, making higher highs and higher lows. So why is this important? Because this is the law of the trend. An established trend in price is statistically more likely to continue from one interval to the next than it is to reverse. So what does this mean? This means that when a stock is on an uptrend, the probability is that prices will continue moving higher. It's like kind of like a river current, right? You always want to swim with the current. You never want to swim against the current. And it's like one of Newton's law, Newton's first law. An object in motion will continue in that motion until acted on by a physical force. So until the trend changes, you have to stay long on an uptrend. You want to buy and hold on the uptrend. At the same time, on a downtrend, the probability is that prices will keep going lower. And again, it's kind of like a river current. In this case, the river is flowing south. You never want to buy, you never want to hold when the price is on a downtrend. Because no matter how cheap it looks on a downtrend, cheap will get cheaper, low will get lower, right? And you never know how low it can go, because remember, the market is not logical. The market is emotional in the short term. So you never want to catch a falling knife holding on a downtrend, swimming against the current. You're more likely to drown. You always want to wait for a downtrend to reverse into an uptrend before buying or holding a stock. So once you're able to identify a new trend and identify the reversal of a trend, that's how you profit tremendously from it. So let's take a look in greater detail what the different trends are all about, and let's define them. So the first kind of trend is known as, once again, an uptrend. So how do you define an uptrend? It's defined specifically as higher highs and higher lows. So once again, you can see Bowings on an uptrend over this period. It makes higher highs, right, and higher lows. So on an uptrend, prices still come down. They still retrace or they dip. But every time it retraces, it goes higher. Retraces, it goes higher. Retraces, it goes higher. On an uptrend, what does it tell us about the market? What does it tell us about the stock? It tells us that the market is bullish or the market is optimistic. So it is bullish, again, prices will continue going higher. So what do you want to do on an uptrend? What do you want to do on an uptrend? Well, most of the time you want to buy on the uptrend, right? So when is the best time to buy on the uptrend? Would it be best to buy, for example, over here at A or buy over here at B? The answer, B, right? Why? Because remember that when you buy, you always want to buy at the lowest price. So you always want to buy at the lowest price of the uptrend. Once again, would you rather buy at A or would you rather buy at B? And once again, the answer should be B, right? Because you always want to buy at the lowest price to make the greatest profit when it goes up. Okay, so in other words, we always want to buy when the price makes a temporary dip on the uptrend. We call this a dip. Dip, 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 right? We call this a dip. Now, we also call this a retracement. So notice that prices don't go up in a straight line. They move in waves, right? So we call this the impulsive wave, and we call this the retracement, right? Impulse, retracement, impulse, retracement, impulse, retracement, and that pattern continues. Think of it like breathing, right? So you got to breathe out. You can't breathe out forever, all right? You got to breathe back in and breathe out again, breathe in, breathe out again. So you always want to buy on the breathe in, on the retracement. So let's take a look at this next on the chart. So there you go. You always want to buy the dip of the uptrend. Okay? Now, at the same time, are there people who sell the stock on an uptrend? Yes. When the uptrend is too overextended, when the price has gone too high and they expect it to dip or to retrace back to the mean. So again, the price goes up and it's overextended, we anticipate it's going to, that's right, retrace. Extend, retrace, extend, retrace. So over here is where people or traders are likely to sell, because they think that once you have breathed out too much, you gotta breathe in, right? So anticipating that they gotta breathe in, the price is gonna come down temporarily, what do? They sell over here. Now they either sell to take profits from buying here, or they do a short sell, right? They sell short. So they profit as it comes back down. But notice that by doing this, you're actually doing what we call a counter trend trade. You're trading against the trend. So it's a bit risky, isn't it? That's right. So if you do a short sell over here, you have to quickly ensure that you buy back the shares to take your profit before the uptrend continues. So in other words, on an uptrend, you either go long during the dip of the uptrend. In other words, you buy on the dip of the uptrend, and we call this trading with the trend, or we call this trend following. Okay, or you go short, right? You sell short during the top of the uptrend over here, the top of the uptrend, anticipating that it will revert back to the mean before continuing going higher. We call this a counter trend trade. So usually, if you are more of a medium to a long-term investor, all right, you definitely want to buy with the trend. You definitely want to follow the trend. But if you are a very short-term trader, you're kind of like a hit and run, you're in and out within a few days, or sometimes even a few hours, then you could likely just as much buy at the dip of the uptrend and quickly sell before the retracement, or you sell at the top of the uptrend and you buy back at the retracement level. So next question would be this: how would you know that it is at the bottom of the dip? All right, like for example, it goes up and the price is coming down, coming down, coming down, coming down, right? And you say, okay, buy over here. Now, how would you know that's the bottom, right? What if you bought over here and it kept going down? And you say, oh my God, right? It's reversing to a downtrend. How would you know, right? At the same time, how would you know this is the top, right? What if you thought, hey, that's high enough, that's the top, and I'm going to short sell, and it keeps going higher? Then you're screwed, right? So how would you know? So one way is to use moving averages, candlestick patterns, as well as technical indicators to kind of help us to determine if the price has dipped enough or is extended enough. So right now we're going to look at, very quickly, a quick word on moving averages. So once again, we either buy the dip or we short the top of the uptrend. Now what's important is that when the price retraces on a dip, okay, it has to hit a level of support. The support level could be a trend line, which you're going to learn in a short while, or it could be a moving average. And only when it hits a level of support and it bounces off the support do we enter the trade. So you never anticipate or you never guess that it's going to continue. You wait for confirmation that it's going to continue after it has hit a level of support and bounced off that level. So let's take a look at how we could use moving averages for this. So this is the same stock. Now, in this case, we have put in the moving averages, which is the blue line, the 50 moving average, the brown line, which is the 100 moving average, the green line, the 150 moving average, and the 200 moving average. In the next part of this lesson, I'm going to teach you about moving averages in greater detail. But for now, just understand that these colored lines are moving averages that you can place into your chart. All right? And notice that on a very clear uptrend, the price tends to retrace and bounce off the moving average very consistently. Can you see that? So the price goes up, comes down, boom, hits the moving average, which is a support, bounces off, and continues the trend, comes back down again. In this case, it doesn't reach the moving average, but it bounces up again, and this time it touches the moving average again, goes up, touches it again, goes up. In fact, one of my strategies in buying the dip is to buy when it bounces off the moving average. It is called the bounce strategy. Okay. At the same time, we know that it's ready to come back down when the price gets too far away from the moving average. When it's kind of like a rubber band, when you stretch it too far from the center, it's going to bound to snap back pretty soon, right? So moving averages help us to anticipate where's the price. Is it too far up or is it ready to reverse? Let's take a closer look at downtrends. So a downtrend happens when price is making lower highs and lower lows. All right, you can see this is a very clear downtrend on ECT. Over this period, you can see the highs over here. These are the highs, right? So once again, price is making lower highs and lower lows. Like so. So that's a really clear downtrend. Now, this is a lower high. Now you may notice that, hey, this is making a higher high than this. So this was an attempted change in trend. But did it make a lower high? Or rather, did it make a higher low? No. So although it made a higher high, but it made eventually a lower low. So it was not a successful trend reversal. And so the downtrend continues. So on a downtrend, probability is that prices will go lower because the market is bearish. The market is pessimistic. Okay. So what do you want to do on a downtrend? Again, there are two things you can do. Number one, follow the trend. And if you follow the trend, you want to sell on a downtrend. Or we call it, you want to go short, right? You short on a downtrend. Now, when is the best time to sell? Do you want to sell at, for example, A, right? Or sell at B? Okay, so you probably say, hey, sell at A, right? Because as a seller, you always want to sell at the highest price possible. So you sell high, you buy back low. Okay. At the same time, would you want to sell at A or sell at B? So once again, you want to sell at A, right? So you always want to sell at the highest point of a downtrend. And we call that a rally. So what we call this? We call this a rally down, rally down, rally down, rally down. So a rally is a short-term upward retracement. And you always want to sell at the rallies, right? You always want to short at the rallies of a downtrend. Okay? Now, at the same time, on a downtrend, notice that prices don't just go down, right? They will retrace back up. All right? Again, back to our breathing metaphor. Okay? Breathes out, breathes in, breathes out, breathes in, breathes out. Okay? So what happens if it goes too low and it's overextended to the downside? Right? It's like breathing out. What has to happen? You got to eventually retrace before continuing the downtrend. Okay? So what some traders do is, once they recognize that the price has gone down too fast and too much, they will buy when it's oversold. Again, when the rubber band is stretched too much to the downside, they buy in anticipation it's going to snap back up, and they make a quick profit as it goes up. But you got to quickly sell over here to exit your long position before the downtrend continues. All right. So similarly with the uptrend, on a downtrend we can short on the rally, and by doing that we are following the trend. We are doing trend trading, trend following. Or we could also buy at the bottom of the downtrend, anticipating the rally before the continuation. And that is called a counter trend trade. Because again, we are buying against the trend. We are buying against the trend. So once again, most beginners, it is actually simpler to follow the trend. So you sell on a downtrend. But if you're more of a swing trader, a day trader, you're getting in and out really fast, then you could also buy at the bottom of a downtrend and get a quick profit as it rallies up. So once again, how would you know that the price is at the top of the uptrend? Okay, how would you know? I mean, the price could go up and you say, oh, it's high enough, I'm going to sell. And what happens? That's right, it keeps going up. Right? And you say, oh my God, I'm screwed. Right? So you never want to guess that the price is going to continue. You must wait for confirmation. So similarly, when the price goes up, you want the price to hit a level of resistance that it cannot break. For example, it's a trend line that you will learn in a while, or a moving average. And when it hits that resistance, only when it comes down do we sell and capture the downward move. So take a look at the next chart with the moving averages. And again, the moving averages act as very strong resistance. So you have got the blue, the brown, the green, and the red. And all these are different moving averages that you will learn in a short while. So notice the price retraces, hits the moving average, which is a resistance, and boom, comes back down again. Goes up, hits the moving average, comes back down again. Goes up, hits the moving average, goes back down again. So it's a very, very predictable pattern when you see a very clear downtrend. You always want to sell the moment the rally finds resistance at a moving average or a trend line. Similarly, how do we know that the price has gone down far enough that it's overstretched and likely to reverse back up? Again, we take reference to the moving averages. When the price goes too far from the moving average, it's like a rubber band, right, being overstretched, and likelihood is going to reverse back to the moving average. And that's when we buy. So we'll include other things like Bollinger Bands, which you'll learn in a while, candlestick patterns to better anticipate when the price has reached its bottom. Finally, let's look at consolidation patterns. So prices can move on an uptrend, they can move on a downtrend, and finally they can move sideways or directionless in a consolidation. So notice in a consolidation, the price can't move beyond a certain price level and it can't move below a certain price level. For example, over here you can see that price is attempting to go up, and what happens? The moment it hits $49, it reverses down. And it attempts to go up again, hits that same price level or similar to that level, that area, and price reverses back down again. Goes up again, boom, comes down again. Goes up again, boom, comes down again. So what does that tell you? It tells you that at $49 or $50 thereabouts, there are many sellers that are waiting there. Sellers are waiting there, and the moment the price reaches that level, they start selling like crazy. So what it tells you is that $49 in that area, supply exceeds demand, okay? Or we call it a supply zone or a resistance level. Now, remember, resistance levels is never an exact line. It's more like a zone and area, beyond which the price just can't seem to clear because there's excess supply that exceeds demand and pushes the price down again. Now, at the same time, when the price wants to go down, it can't go down beyond a certain level. All right, price goes down, goes down, goes down, goes down, and the moment it reaches $37, what happens? Boom! Buyers rush in and push the price up. When it comes to 37, or again close to that area, buyers rush in and push the price up. Push the price up, push the price up. So what does it tell you? It tells you that at $37, people psychologically think that it's cheap. So buyers are all queuing up, waiting to buy. The moment price comes to a level, buyers rush in and demand exceeds supply, and it pushes the price up again. And that's the psychology behind resistance and support levels. It's demand and supply imbalances, right? So again, at support levels, demand exceeds supply. At resistance, supply exceeds demand. And very often in the consolidation, it is stuck between these two levels where it makes same highs and same lows. Okay? Same highs and same lows. And usually we require it to be tested at least 3 times to be a significant resistance or support level. So that's 1, that's 2, and that's 3. Okay, that's 1, that's 2, that's 3. So at least 3 tests for it to be significant. So in a consolidation, do you want to buy? Do you want to sell? Well, in general, the answer is no, because you don't want to be stuck going sideways for, who knows how long, right? So what happens is, if I can draw on this chart, for example, price is going on an uptrend in this way, going up, going up. And after a while, what happens? It goes into a consolidation, right? Makes same highs and same lows, like that. So what happens after a consolidation? It's kind of like this person is running a marathon, okay? And then after a while, he has to rest, right? To consolidate, go sideways. And what happens after a consolidation? Well, 2 things can happen. The price can either break out of that previous resistance and continue the uptrend, or the price can break below that support level and reverse into a downtrend. Now, you never know what's going to happen until it happens, okay? So traders always want to wait for a break above the resistance before buying, going long, and riding the trend up. Or they wait for a break below the support to start selling short and to ride the trend down. And before it happens, you do not want to do anything. Now, having said that, sometimes if the range between support and resistance is wide enough, you could make money by buying at the support level when it bounces off, selling at the resistance, buying back near the support, selling at the resistance, and continue this process. So this technique is called trading the range. Trading the range, right? Buy, sell, buy, sell, buy, sell. But the range has to be wide enough. Now, some of you may be asking, how do I know if it's wide enough? Well, here's a little thing that traders look at. For example, over here when I see, for example, the price is coming down, right? And it is hitting the support level that has been tested before, okay? So what traders usually do is they also look for some kind of candlestick pattern that confirms a reversal. That would be ideal, okay? Or they can use Bollinger Bands to see that it has the price hit the lower Bollinger Band. So that adds to the probability. So in this case, for example, after it bounces off $37 and you decide to, for example, buy over here. And let's imagine you buy at, say, $38. Okay? Anticipating the price to run up to 49. So what's your profit potential? 49 minus 38 is $11. So you have got a potential profit of $11 if the price goes back to resistance, right? So that's your potential return. Now, is it worth the risk? Well, it depends, right? So where do you put your stop loss? So usually you want to place the stop loss below that support level. Okay, it depends on how conservative you are. You may say, okay, I'm going to place it maybe a couple of cents below this support level. So this support is at, say, 36.80. All right, you may want to place your stop loss slightly below that. You've got to give some buffer because remember it's a zone. Okay. Now, if you want to be really conservative, you may say, okay, I'll put my stop loss at, for example, $36. Okay, because sometimes the price may not exactly touch and go off. It can sometimes, that's right, it can sometimes break below it slightly and run up again. So you got to give a bit of buffer. And to be safe, usually we give the buffer based on the stock's ATR, or average true range. I'll talk more about it on the lesson on technical indicators. So ATR is known as average true range. It represents the average range of the candles of this particular stock. What's the average volatility? Okay. So for example, for Las Vegas Sands, you could calculate that the ATR is, for example, $1. So that means on an average day, Las Vegas Sands moves by $1 in volatility. And any charting software will have an indicator known as ATR that you can place it in. It will calculate the ATR for you. And I'll show it to you again on the lesson of technical indicators. Okay, so let's imagine that we place our stop loss about one average true range ATR below the support. So our stop loss is at $36, for example, stop loss. And our entry price is at 38, E for entry. And our target price is at 49. So if we are wrong on the trade, or it's a losing trade, how much do we lose? We lose $38 minus $36. So we are risking $2 on this trade. And we are potentially making $11. So that is a 1:2. That's right, more than 1:5 risk to return ratio. Okay, so that's a great trade probability. Remember, we always want to take trades when the risk to return ratio is at least 1:2. So we always risk 1 to make at least 2 or more. And if you do that, recall that you can be right half the time or even right 40% of the time and you're still profitable. That's the key to it. So here's an example of a stock, Yahoo, that was in consolidation for a couple of months, in fact more than a year, right? So clear consolidation, you can see a very clear level of resistance over here. The price was making same highs at $16.30, could not break. It was a very strong resistance, and again a very strong level of support over here. And eventually in November it broke out of that consolidation, and the moment price breaks out with a high level of volume, and again we have to confirm it with moving averages as well, we'll see it in a while, boom, it starts a new uptrend. So that was a great time to have gone long on Yahoo. Here's an example of a breakdown pattern. Okay, Nokia was in a consolidation again for a couple of months, right? There's a resistance level over there, could not break the resistance, could not break the support as well. Very strong support. Now, eventually it broke the support level in May. Okay, once it broke the support, boom, collapsed all the way down. So that's a good time to have gone short on Nokia. So that concludes this section on trends. Okay, in the next session, we're going to be looking at support and resistance levels.